Warm greetings, ladies and gentlemen. This is a presentation on a text, and this is my 2020 edition that I'm preparing for those who are writing the examination. So I think you can take advantage of the numbers and you contact me. Let's get to today's business. I think today we want to cover capital gains tax, and we are on the principal private resident. And I think you can understand from your previous lectures that usually a PPR is an individual's sole or main residence, right? And it include land up to 2 hectares, right? Then also you must the taxpayer must be at least be should have been there for at least how many years? 4 years. Okay, I think those are some of the key things. But today we want to cover what we call rollover relief. Okay, so we are saying CGT is a sale of capital gains tax on sale of PPR can be deferred. Okay, we are saying capital gain tax can be deferred, that is, can be rolled over if proceeds on sale are used to acquire another PPR. Okay, I think that is very clear. We're saying capital gain tax on sale of PPR can be deferred or rolled over if proceeds on sale are used to acquire another PPR. Okay, then we're saying full rollover where all proceeds are used to acquire a new PPR, right? Then when there will be a partial rollover when some of the amounts have not been used to acquire uh, the other PPR or PPR number 2. So I want to cover this using this example. Let's have an example like this one. This example we want to cover on this one. I think we can take advantage of what is there. Let me take a red pen here. Okay, this is PPR. So I think from our definition, I think you understand this. This PPR was bought for how much? 60,000. Was sold after 3 years for 90,000. Okay, this is the gross capital amount. Then the same amount was used to acquire another PPR. This is the other PPR. Okay, this very same amount was used to acquire another PPR. Okay, so we are actually saying the 90,000 was used to acquire PPR2 that was costing how much? $100,000, right? Then later, after 2 years, the PPR2 was then sold for 80,000, and the amount was used to acquire another PPR number 3. Okay, so I think you can actually follow from this question. Okay. Then the question is, how do we compute the allowances? How do we compute the potential capital gains and so on? So that's what I'm going to cover today, and I hope you'll be following. Okay, this is an example, first solution for the first part. Okay, I think let me just show you the question. We want to determine the potential gain from the asset that was sold for 90,000, of which the cost was $60,000 after using it for 3 years. Okay, so what you do is you determine the gross capital amount from your Capital Gains Act. You can actually see that this is the gross capital amount, which is 90,000 from our previous slides. You can actually see that it's actually 90,000. Okay, then we deduct all allowable cost. Okay, according to this section 11, it can actually tell you which cost are you supposed to deduct. And in this case, we can deduct the 60,000, which is the cost, less cost of acquiring the asset. Okay, so this is allowable deduction. Then we have got the inflation allowance, and it's charged at 2.5%. Okay, and you consider the duration and also the cost of the asset, and this will give us 4,500, and the total allowable deduction in this case is 64,500. Then we get the potential gain of how much? Potential gain, which can be taxable in this situation, is 25,500. But I think from my introduction, we can actually see that this amount, we can roll over the full amount. Why? Because we can actually see it from this. We want to see whether we can roll over the full amount. The whole 90,000 was used to acquire another PPR. So we are expected to roll over the full amount. So we are saying the 25,500 is fully rolled over or is deferred to another future date. Okay, but the question is, how do we compute the potential gain or the rollover amount when PPR2 is then sold? Okay, PPR2, let me just go back to see the principal private resident. Okay, this is the situation that we have now. We then sold the principal private resident number 2, okay, for 80,000 after 2 years, and then we acquired another another principal private resident for $50,000. You can actually see that the whole amount has not been utilized to acquire the other principal private resident. So we need now, this is what we call partial rollover in this case. But here we had, in the first scenario, we had a full rollover. Why? Because the whole amount of 90,000 was used to acquire a principal private resident of how much? Of 100,000. But in this case, this is partial rollover. Why? Because the proceeds, the gross capital amount that was realized after selling the principal private resident number 2 was not fully utilized to acquire the PPR number 3. So we need now to see how we go about it, and we are going to use solution number 2. Okay, so we are saying gross capital amount from our question. I think you can actually see it was disposed or realized. It realized 80,000. All right, then we are saying there's another section where we are expected also to deduct. I think this one you can actually, no, for full notes, I think I can actually explain for you. But let me show you this one. We are saying the amount that was rolled over in the previous scenario, the 25,000, you can actually see this 25,500 is used to reduce the cost of acquiring the asset. So instead of using $100,000, we are going to use 100,000 minus 25,500, the PPR1 rollover. Then we get how much? 74. This is what we are going to use now, okay, as the cost. So this is now 74,500. Then we allow the inflation allowance. This is 2.5 times 2 years times 100 times 100,000. Okay, let me just hold on this one. All right, let me see what I can do. Okay, let's continue with the presentation. So we agreed that we are going to say 100 minus 25,500, then we get 74,500. Then we allow we determine the inflation allowance in this case. Okay, so we are going to say, in this case, we are going to say 2.5% times 2 years times $100. Then we get 5,000. Then we get our 79,500. From this, we deduct it from the gross capital amount. Then we get the potential gain of how much? The potential gain in this case is what? $500. Then we are expected, this partial rollover, we are expected to use this what? Formula. Okay. If you book your lectures, I think I can actually explain this to you. But we are saying, we say A times what? C all over, or divide by, we just divide everything by B. So we can actually erase this section, and we say everything, we divide this everything by what? By B. Okay, or as it was before. Okay, we divide this by B. So how do you determine now the amount that is rolled over? We are saying the component that is rolled over in this case, we're saying the 50,000 that was used to acquire the PPR number 3 over the gross capital amount that was realized, we multiply by 500. This amount is rolled over, but the extra of this, the difference between 500, the difference between this 500, okay, this 500 and this 80, okay, is fully taxable. So we are saying 50 minus 50,000 minus 80,000, we get what? 30,000 over 80 times 500. This amount is fully taxable. It cannot be deferred. Okay, so this is rollover, and I'll give you an assignment that I want you to do and see whether you can actually apply what I've been teaching you. Okay, this is a situation. but I've changed the figures, but I think the concept is still the same. So you are expected to calculate the taxable amount when PPR2 is finally disposed 10 March. So you do this work and you inbox me, or you just connect, submit to our class, our Google class. Then I can mark it from there. Okay, book your lecture today. Then we can also have our lessons via Zoom, and we see to it that you make it to your in your examination. Thank you. Bye bye for now. Wish you all the best in your exams. Okay. Thank you so much. Thank you so much. Thank you so much. All right. We are good to go. In this case, we are done.